If you're looking for a battleground stock in the age of software as a service and the SaaS apocalypse, look no further than ServiceNow. The AI orchestration company reported earnings after the market closed today, and shares are down by over 10%. So what happened during the quarter? What does it mean for investors? And where does that leave valuation right now? My name is Brian Stoffel. At the time of this recording, I do not own shares of ServiceNow. I want to give a big shout out to Fiscal AI for sponsoring today's video. You're going to see a whole bunch more from them in just a minute. All right, so first off, this is the first quarter of 2026 for the company. When the market opens tomorrow, the market cap will be somewhere in the ballpark of $95 billion. Now, if we look at the headline numbers, you might be wondering, well, where is the alarm? Why is it down so much? Revenue grew 22%, which beat analyst estimates, and management just guides for subscription revenue growth, but it came in ahead of that as well. And on the bottom line, there was good news there too. Earnings per share was slightly ahead of analyst estimates. Management guides for non-GAAP operating margins, and they beat those by 50 basis points. But that's where a lot of the good news ends. And there's a lot of moving pieces here that we need to go through. But let's start with this. The margin picture is not pretty. Gross margins contracted meaningfully. Operating margins contracted. Net margins contracted. Free cash flow did grow, but nowhere near the same 22% growth that we saw in revenue. And the same was the story for net income. Now, all that being said, ServiceNow is not in any existential danger. They have a very large cash balance. But let's go through the income statement to look at this, because there are dynamics at play. Maybe right now is a good time to pause and talk about these dynamics. One of the big concerns when it comes to seat-based software as a service, of which ServiceNow traditionally is that two things are going to happen. Thing number one is that companies are going to pull back on their seat-based licenses. And they're going to do that because if the AI that ServiceNow offers through Now Assist is super effective, then in theory, one person could get done the job of many people. So it'll pull back on those. Now, if Now Assist, AI-assisted revenue, can more than make up for the difference, then the thought is, well, then that's not a problem. Except we have to think about margins. Because in the old schema, when you had seat-based revenue, you just shipped the code. There was no incremental cost to adding an additional customer. But that's not the case anymore because the company has to use tokens and compute. You've got to be able to pay for what all the hyperscalers and the LLMs are doing with their data center build-outs and their chips and the energy required to make them run, and the fact that supply still nowhere near meeting demand. And so the margin profiles of those are different, which is why it's a little bit alarming to see the margins coming down so much. So let's go down, knowing that, let's go down and look at this. So as I said, total revenue is up 22%, not bad. But look at this, the cost of that revenue grew by twice as much. Now, admittedly, the only part that really matters of this is the subscription revenue. Professional services, the company actually loses money on, and they don't try and hide that fact. But if we look at their GAAP gross margins for subscription, there is serious contraction here. And it's worth remembering that in as much as that contraction could be due to the tokenization and the growth of Now Assist, it's still a very small part of the overall business. It's not even 10% of revenue. So as it grows, who knows what this margin profile might look like? And I'll show you why that's so important. So subscription gross margins fell quite a bit, from 81.3% down to 77.7% year over year. And that is a huge headline that I don't think enough people are appreciating and respecting and understanding. Now, yes, it is true that revenue growth could more than make up for it, but right now, that's not the case, and that's certainly not a guaranteed outcome. That's why gross profit was only up 16%. That's coded red because that is slower growth than overall revenue. And look at this. The company did do a good job of controlling operating expenses. They were only up 17%. So operating expenses only up 17% on 22% revenue growth. And yet, because those gross margins contracted as much as they did, income from operations still did not grow by as much as revenue did. And that's Not good, all things being equal. Now, net income grew slower, but that's less meaningful because there's a lot of stuff in between those two lines that doesn't really matter. And it is worth noting that the company, although they do hand out a lot of stock-based compensation, bought back a lot of shares, and in buying back those shares, the share count did come down. Now, it's always worth looking under the hood and seeing what else is going on. And for that, I always use Fiscal AI, the sponsor of today's video. If you want to use Fiscal AI, just hit that top link in the show notes below. And if you want full functionality, using that link will get you 15% off an annual membership. So I've gone over to Fiscal AI and I've pulled up a couple of different things. Now, the first thing that I pulled up is the total number of customers that are spending at least $5 million per year. And when we look at this, there is some good news here. It came in at 630 total customers. Notice all this data is in, and the company just reported. So Fiscal AI gets it uploaded quick. And what's good to see is that over the last 2 quarters, the number of customers spending at least $5 million per year in annual contract value has been growing, and that growth has been re-accelerating from 18% to 22%. All in all, that's not bad news. And when we look at that same cohort and say, well, we know it's over 5 million, but on average, how much is it? It's actually close to $15 million in average contract value. Now that seems to be slowing a little bit. So what we're really seeing here is a lot of customers crossing that threshold from, say, $4 million to $5 million. A couple other things worth noting here if we look using Fiscal AI that I would like to call out. The first one is just, I think it's important to look at, this is the big thing, current remaining performance obligations. And I'm going to pull this up on an annual view. So what does current remaining performance obligations even mean? That just means that remaining performance obligations, that is like money that the company has collected and believes that it will be able to recognize as revenue over the next year. And it is a really, really important forward-looking indicator of what the company is doing. Okay, and so what I want to show you is this. I want to look, this shows you that there's about $13 billion in remaining performance obligations that are expected to be realized over the next year. But what really matters to me is this number right here. So this is current remaining performance obligations, and it's showing its growth or lack thereof over the last couple of years. And in fact, we can actually pull this out even more. And so what we see here is, you know, it is understandable that it is not going to be able to grow at 30% plus per year. But here's where the problem is. Current remaining performance obligations. The narrative that management wants to have us believe right now is that AI is going to re-accelerate revenue. CEO Bill McDermott spent a whole bunch of the conference call talking about how AI was going to re-accelerate revenue. Now, if revenue is going to re-accelerate, what you need to see is a re-acceleration of current RPO. But that's not what we're seeing. If we go and look at this on a quarter-over-quarter basis, here's what I want to show you. And I'll narrow this timeline so we can give a more accurate picture of what's actually going on here. So I'm going to narrow this, and here's what I want to show you. Is that current RPO is kind of up and down, and that's because it can be lumpy, and there's nothing wrong with that. But current RPO came in at 22.6% during the first quarter. But importantly, if it was on a constant currency basis, that would have actually been at 20.6%. They rounded it up to 21%, but if you read the details, it was 21.6. And here's the problem. When they guided for how much will current RPO grow in the second quarter, they guided for 19.5%. Okay. The problem with that is the fact that they admitted that a recent acquisition that they made of Armis is boosting that current RPO. And what it's really going to come in at is like 18.25, 18.5%. Now you might be saying, man, isn't that splitting hairs? Well, here's the thing that you have to remember. Management has said and made clear that AI will re-accelerate our revenue growth. I will say that again. The message has been AI will re-accelerate our revenue growth. And yet, the current RPO looking forward, if you strip out the company, then the revenue that they just bought is not telling that story, at least not yet. And that's important to note. If we look at what else was going on, the other thing that I really want to point out is I just harped a lot on those gross margins. what you can see here is from December 2021, so the beginning of 2022, all the way through March of 2024, those gross margins were expanding. And this includes stock-based compensation. They expanded to 80%. But what we've seen since, and there are some integration issues that might be a part of this, but look, we are seeing an erosion, not a red flag erosion, but definitely a yellow flag erosion of gross margins. And because you have to pay for AI compute, I would not be surprised to see this continue, and it must be factored in to your considerations when we talk about valuation, which we'll do in just a minute. So that's where things that I want to point out is the company's renewal rate. Now, they have fantastic renewal rates. You can see going back to September 2021, they never went below 98% renewal rate. In other words, they were losing about 2% of their customers per year, sometimes just 1% of their customers. Now, it did fall in the third quarter of last year to 97%, which again, you might think is just splitting hairs, but that was significant enough that the company went out of their way to point out that that renewal rate falling to 97% in the third quarter, they said was just because of a federal government contract that they lost. And they said without that, it would have been 98%. So the fact that they were willing to go out of their way and talk about why that happened then means that they were at least aware that that could be alarming. But what you see in this most recent quarter, and really was not talked about at all, is that it did drop down and there was not additional information given for why that happened. Again, I'm not saying that this means that there's smoke, but what I am saying is that will not tamper down fears about the fact that renewal rates could be falling in the face of other alternatives that companies might have. All right, now let's go to the guidance because there's some really important context here. Now, again, management only guides for subscription revenue growth, and they guided for strong revenue growth at 23%. That is faster than the overall revenue growth that analysts were expecting. Now, there's one thing I want to explain about that revenue guidance bump, because throughout the conference call, Bill McDermott, the company's CEO, said, guys, it's a beat and raise. It's a beat and raise. And he was even talking about the full year guidance being a beat and raise, a beat and raise. The problem with that is that it wasn't. It was not. And don't take my word for it. The CFO said just as much on the conference call. She said, we did not increase the revenue guidance except excluding Armis. So the only reason it was a beat and raise is because they bought a company. It's intellectually dishonest to say that. Now, so you might say that that's a big deal. Some people may say that that's not a big deal, but it is provable that the CFO said, we did not raise guidance excluding Armis. The other problem was the CFO said, well, yeah, but also we typically don't raise guidance during the first quarter. I went back and checked. In the first quarter of last year, they raised guidance midpoint ever so slightly. Most of that was from bringing the bottom up a little bit. But go back just 2 years and they raised guidance in the first quarter quite significantly. So again, that is just intellectually dishonest. And it is worth calling out. The other part of this that I think spooked investors a little bit is earnings guidance, because management said that the operating income was expected to come in at about 26.5%. Now, that's much lower than the 32% on a non-GAAP basis that they had in the first quarter. A lot of that has to do with integration, and it is worth noting that they maintained their full-year margin guidance. So that might be one-time in nature, but I think that is part of what has people spooked. So what should shareholders watch moving forward? I definitely think the first thing is organic, constant currency RPO growth. All that means is the underlying business, is it reaccelerating its revenue growth? Now, all things being equal, it's fine if a company is not reaccelerating their revenue growth. But if management is promising that this new technology that has people scared is going to reaccelerate revenue growth, well, then you better see that in the current RPO. Number two, those subscription gross margins, they need to stabilize. Number three, operating margins. Management has promised that they're going to re-expand in the third and fourth quarter, so that better be true. And number four, keep an eye on that renewal rate. A bump down from 98 to 97% is not the end of the world unless it's the start of a trend. Now, overall, I think that the moat direction is uncertain, and I want to say that the reason I say that is because this company could survive. And the valuation, which we'll get to in 1 minute, might be very appealing. But we've got to understand the unit economics and how that can be different in the age of agentic AI. So before we get to subscription, I just want to let people know that I have been following my own portfolio and tracking it for years. My results still beating, although this year has been very tough, the NASDAQ composite and handily beating the S&P 500. Now, I run a program called Stock Investing Mentor, where we've talked about all of these things in detail, and I explained why I sold my shares of ServiceNow about 20 or 30 or percent ago from where it is right now. Now, Stock Investing Mentor comes in 3 parts. The first is 1 hour of live weekly sessions that are recorded Thursdays, noon Eastern. Number 2 is full real-time access to my portfolio with video explanations as they happen for any moves in my portfolio. And number 3, 24/7 online access to a private investing community. If you would like to become a member of Stock Investing Mentor, hit that second link in the show notes below and you can get 10% off an annual membership. All right, so let's talk about the company's valuation. Now, there's a couple different ways to do this. I think one of the ways to do this is we could just look at their forward valuations. We could say, how much is ServiceNow trading for on a forward PE or a forward price to free cash flow basis? And I think when you see this, if you're a ServiceNow bull, there's going to be a lot that you like to see, because look at this. Right now, the company is trading for about 24 times forward earnings. And its average over the last 10 years is about 71 times forward earnings. So that looks like a pretty good deal. Let's also look at their forward price to free cash flow. They're trading at only about 18 times forward free cash flow. And over the last 10 years, the average is about twice that, 40 times forward free cash flow. So you might say, this is really cheaply valued. But I think a better way of thinking about this is looking at a reverse discounted cash flow analysis. Now, the first thing we have to do is we've got to figure out what type of free cash flow margins are we going to assume that this company can have in the future. Now, let's remember, management has said they're going to pull down stock-based compensation a whole bunch. McDermott spent a bunch of time talking about that during the conference call. If they do that, they're either going to have to increase their operating expense per employee because they've got to make up for the gap there, or they need to get rid of a whole bunch of employees. Either way, if we look at their free cash flow margins over time, and this is actually better to look at on an annualized basis because it can be very lumpy, we can see that it approached 30% and has gotten as high as about 35%. Now, I believe that we need to pick a figure that's between 25 and 30% as a fully optimized free cash flow margin. Why? Because stock-based compensation is a lot of that free cash flow right now. That's number one. And number 2 is the gross margins are getting compressed. We've seen it happening. And management upped their guidance for Now Assist, which on one hand is great news. They used to say we'll get $1 billion in Now Assist annual contract value by the end of 2026. They're now saying it'll be $1.5 billion. Again, great to see that growing so much, but it has a different margin profile, and we're not yet sure what exactly that'll be. So if I were to choose, I would choose a terminal free cash flow margin of, let's cut the difference in half and say it is 27.5% free cash flow margin. So if we take that and we then multiply it by their trailing revenue, which is currently about $14 billion, then we get an optimized free cash flow of about $3.8 billion. All right, so let's type this in. This is Now, and we're saying that they have $3.8 billion in trailing optimized free cash flow. So how fast does the company need to grow per year over the next 10 years in order to justify today's stock price? We'll give them a normal 2% discount rate, a 2% terminal growth rate, a 10% discount rate. And what we see is they need to grow at about, over 10%, maybe 13%. Okay, so they need to grow 13% per year in order to justify today's stock price. How fast do analysts think the company is going to grow moving forward? Well, you can go to the income statement on Fiscal AI, you pull this up, and all you got to do is drag this forward. And remember, what we're looking for here is we want 13% for 10 years. Now, analysts think it'll be 21%, 18, 19. So that's good news. That looks pretty good. Of course, 10 years is much longer than just 3 years, but we can also look and see, well, how do they do against these estimates? And so we pull this up on Fiscal AI. It's one of my favorite things to look at. And what we see here is that, well, in 2024, the estimates did bump up a little bit. In 2025, they went up and down. For 2026, they've gone down and then up, and I don't think they're quite back to where they used to be. It's about the same. So let's just say that these estimates are largely accurate. So what we're talking about is a company that's going to need to grow by an average about 10% per year from year 4 through year 10 to justify this stock price if it is able to accomplish 27.5% free cash flow margins. And remember, stock-based compensation, gross margin compression are the two big questions. So overall, I do think that ServiceNow seems like a pretty good deal in terms of valuation, but there's a lot of moving pieces here. And I'm not necessarily a ServiceNow bear. I don't own shares anymore. But when I see bull calls that don't take into consideration the potential loss of that seat-based gross profit and the growth of Now Assist, which seems great on the surface, but you have to account for the margin compression, well, then I don't think we're getting the full picture, just to be understood completely of where I'm coming from here. So that's what I thought of ServiceNow. Leave in the comment section your feedback of what you think of ServiceNow's quarter, and don't forget to hit subscribe when I talk about ServiceNow next in 90 days. Until then, Brian, out.